In 1942, an 11-year-old boy spent $114 on 3 shares of stock. If he'd simply held them differently, that money would be worth $400,000 today. The boy's name was Warren Buffett, and he made a mistake that haunted him for 76 years. This wasn't some random kid playing with pocket change. This was a future billionaire who'd already read every investment book in the Omaha Public Library. A boy so obsessed with money that he'd calculated exactly how much he needed to retire by age 35. He bought his first stock just 3 months after Pearl Harbor. Cities Service Preferred, $38.25 per share. Within 90 days, the stock plummeted 30%. His sister, who he'd convinced to invest alongside him, reminded him of their losses every single day. When the price finally crawled back to $40, he sold. $5 profit, relief. Then he watched the stock skyrocket to $202 per share. The math is striking. If he'd held those 6 shares, he would have made over $1,000. That's 10 times his entire savings at age 11. But here's what makes this story matter. This wasn't just about missing a profit. This was the moment Warren Buffett learned the most important lesson about building wealth. A lesson that turned $114 in childhood into approximately $146 billion fortune by age 95. So what went wrong? And more importantly, why do experienced investors in their 50s, 60s, and 70s still make this exact same mistake? In the next 15 minutes, we'll break down the cognitive bias that trapped an 11-year-old genius and still affects portfolios today. Picture this. It's March 1942. America has been at war for 3 months. Young men are shipping out to the Pacific. Rationing has begun. And in Omaha, Nebraska, an 11-year-old kid walks into a brokerage office with his entire life savings, $120. Warren Buffett wasn't like other kids. While his classmates collected baseball cards, he was reading a book called 1,000 Ways to Make $1,000. He delivered newspapers before dawn. He sold chewing gum door to door. He bought a used pinball machine and placed it in a barbershop, splitting the profits. Everything he earned, he saved. Everything he saved, he invested. And now, finally, he was ready to buy real stock. He chose Cities Service Preferred, a natural gas and oil company supplying the Midwest. The ticker price was $38.25 per share. He could afford 3 shares for himself. But Warren had a partner. His older sister Doris. He convinced her to invest too. 3 shares for her, 3 for him. 6 shares total at $38.25 each. $114.75. That was 95% of everything he owned. Years later, Buffett would admit something crucial. I didn't understand the stock very well when I bought it. He was impatient. He wanted to get started. He wanted to be in the market. The logic seemed sound enough. America was ramping up war production. Energy companies were essential. City service had been around since 1910. It felt safe. And for an 11-year-old delivering newspapers at 5 a.m., owning shares in a real company felt like power. His sister trusted him. His family trusted him. He was the money-smart kid, the one who understood this stuff. So on March 11th, 1942, Warren Buffett became a shareholder. He had no idea he was about to learn the most expensive lesson of his childhood. Within weeks of his purchase, the stock began to fall. March turned to April. The war news was grim. The Philippines were falling. Singapore had surrendered. And Cities Service Preferred was dropping. $35 per share. $32. $29. By June, the stock hit $27. Warren's investment had lost 29% of its value. $34 gone. More than he'd earned in a month of newspaper deliveries. But the financial loss wasn't the worst part. His sister Doris reminded him every single day. Warren, how much have we lost now? Warren, are we going to lose it all? Warren, I thought you said this was safe." He was 11 years old. He'd convinced his older sister to trust him with her money. And now, every morning, every dinner, every time she saw him, she asked about the losses. The pressure was crushing. This wasn't just about money anymore. This was about reputation, about being the smart one, about living up to his own image as the kid who understood investing. Alice Schroeder, his biographer, later wrote he didn't want responsibility for anybody else's money unless he was sure he could succeed. And he was failing. Summer arrived. The stock stabilized. Then slowly it began to climb. $29, $32, $36. Warren watched the ticker every day after school, waiting, hoping. By late summer, Cities Service Preferred hit $40 per share. He'd bought at $38.25. He was finally in profit, $1.75 per share, $5.25 total. Not much, but profit. Relief washed over him. The torture was over. The daily questions from his sister could stop. He could prove he wasn't a failure. He sold all 6 shares immediately, $5 profit. Lock it in. Walk away with his dignity. His sister was happy. The nightmare was over. 2 months later, Cities Service Preferred was trading at $60. 6 months later, $90. By the end of the year, it crossed 100. Warren watched, sick to his stomach, as the stock he'd owned kept climbing. And climbing, and climbing. It didn't stop at 100. It reached 150, then 175. The stock eventually peaked at $202 per share. Let's do the math Warren did in his head every night for months. 6 shares times $202. That's $1,212. Minus his original investment of $114.75. Net profit, $1,097. That was nearly 10 times his total life savings. He'd sold for $5. He'd left $1,092 on the table. But this wasn't about the money. Warren Buffett would go on to make billions. That $1,000 wouldn't have changed his life in any material way. What stayed with him was the lesson he almost missed. Because in 2018, 76 years after that first investment, Buffett did a calculation. He told a Yahoo Finance interviewer, "If I put that $114 into the S&P 500 at that time and reinvested the dividends, the answer is about $400,000. $400,000 from $114. Not because of genius stock picking, not because of perfect timing, simply because of time itself. He'd sold after 6 months. If he'd held for 76 years, that's what compound interest would have delivered." And then Buffett said something profound. He looked at the camera and said, "That's America. One person's lifetime." But here's what makes this story dangerous. 76 years later, investors with decades of experience are making the exact same mistake. Right now, today, in portfolios worth hundreds of thousands. So what really happened here? Why did a kid who'd read every investment book available make such a catastrophic error in judgment? The answer isn't about age or inexperience or bad luck. It's about a cognitive bias that affects portfolios every single day. And even Warren Buffett, at 11 years old, couldn't see it coming. Here's what was really happening in Warren Buffett's mind during those 6 months in 1942. He wasn't analyzing Cities Service's business fundamentals. He wasn't evaluating the energy sector's long-term prospects. He wasn't thinking about compound interest or time horizons. He was anchored to 2 numbers, $27 and $38.25. The first number was pain. The bottom, the moment his sister's questions hurt the most. The second number was his entry price, the psychological finish line, break even. When the stock hit $40, his brain didn't calculate. It reacted. Escape, now before it drops again. This is called loss aversion, combined with anchoring bias. And it's one of the most powerful forces in investment psychology. Loss aversion is simple. The pain of losing money feels roughly TWIC, E as strong as the pleasure of gaining it. Think about it. Losing $100 feels worse than finding $100 feels good. Your brain is wired to avoid pain more aggressively than it seeks pleasure. When young Warren watched his investment drop to $27, that pain anchored in his memory. His sister's daily reminders reinforced it. The fear of losing became more powerful than any rational analysis of the stock's value. Then there's anchoring bias. We fixate on specific numbers, even when they're completely irrelevant. Warren's entry price of $38.25 became his reference point, his anchor. Not the company's actual value, not its future potential, just the arbitrary price he paid. When the stock recovered to $40, he didn't ask, "Is city service worth more than $40? He asked, "Can I finally escape this nightmare with a profit?" Here's how it manifested in 3 specific ways. Evidence number 1. He sold at $40, not because anything changed about the business. City service didn't announce bad news. The war situation didn't deteriorate. He sold because 40 was above his anchor of $38.25. Classic anchoring. Evaluating the decision based on HI's entry price, not the asset's actual worth. Evidence number 2. The relief was overwhelming. The emotional payoff of escaping the $27 memory was so strong that a tiny $5 profit felt like victory. That's loss aversion. The pain of the previous loss was so intense that a NY profit triggered a flood of relief. Get out now. Lock it in. Never feel that pain again. Evidence number 3. Social pressure accelerated everything. His sister's daily questions amplified his anxiety tenfold. The fear of disappointing her, of being wrong, of losing her trust outweighed patience. Buffett later said, if he made a mistake, it might get somebody upset at him. At 11 years old, preserving relationships felt more important than preserving the investment. So why did even a young Warren Buffett, someone who'd go on to become the world's greatest investor, fall for this? 3 reasons. First, he had 0 experience with volatility. This was his first stock. He didn't know that drops were normal, that recovery was possible, that time heals price wounds. Second, 95% of his savings were at risk. For an 11-year-old, this felt existential. Not a learning experience, not a calculated risk. It felt like survival. Third, and this is the one he admitted himself, I didn't understand the stock very well. Without fundamental conviction in the business, he only had the price to guide him. And price is a terrible teacher in the short term. The final outcome stayed with him. Not the money, not the $1,000 he missed, but the lesson about compound interest he almost didn't learn. His biographer, Alice Schroeder, wrote that Buffett would never forget this mistake. And he didn't. This $114 experience birthed 3 principles that built Berkshire Hathaway. 1. Don't sell quality businesses based on short-term price movements. 2. Patience is the investor's greatest weapon. 3. Understand what you own or you'll sell at the wrong time. Decades later, Buffett would say, games are won by players who focus on the playing field, not those whose eyes are glued to the scoreboard. He learned to buy businesses, not tickers. He discovered that compound interest doesn't require genius. It requires one scarce resource, time. In 2018, at age 87, Buffett reflected on that 1942 investment. He wasn't bitter. He was reverent. $400,000. That's America. One person's lifetime. The boy who sold after 6 months for $5 became the man who held Coca-Cola for decades, who held American Express through scandal, who built approximately $100-40-6- billion fortune by refusing to repeat that childhood mistake. So what does this mean for you? Let's be clear about something. You're not 11 years old. You're not investing your paper route money. And you're not Warren Buffett. But the cognitive bias that trapped him in 1942 doesn't care about age or experience. It's affecting retirement portfolios right now, today, this week. Here are the patterns to recognize. Pattern 1. The relief trap. Selling the moment you break even or hit a small profit just to escape the memory of a paper loss. Ask yourself, have you ever watched a stock drop, felt sick about it, and sold the instant it recovered to your purchase price? That's not analysis. That's your brain seeking relief from pain. Pattern 2. Anchoring to your entry price. Evaluating decisions based on what you paid rather than what the asset is actually worth now. Your cost basis is irrelevant to the investment's future. The market doesn't know what you paid. The market doesn't care. The only question that matters, is this investment worth holding at today's price? Pattern 3. Social pressure. Making financial decisions to avoid uncomfortable conversations. Doris reminded Warren every day. Maybe your spouse questions your holdings. Maybe your advisor pushes you to do something. Maybe your brother-in-law brags about his gains. Those voices create urgency, and urgency is the enemy of compounding. So here are 3 questions for self-reflection. Not advice, just questions. Question 1. When you review your portfolio, are you evaluating positions based on what you paid or based on where they're headed? Question 2. Have you ever sold an investment just because it came back to your purchase price, even though nothing about the fundamentals had changed? Question 3. If someone you respect questioned one of your holdings during a downturn, would you sell for emotional relief, or would you reevaluate with fresh eyes? Here's why this matters specifically for investors in their 50s, 60s, and 70s. Time horizons feel compressed. The math feels urgent. You're thinking, I don't have 76 years to compound. Fair enough. But that's exactly why premature selling during volatility can cost you exponentially. Buffett's calculation wasn't based on exotic investments or perfect timing. It was the S&P 500 with reinvested dividends. The question isn't, can I afford to wait? The question is, can I afford not to? Remember, this video is educational analysis of historical events, not financial advice. The patterns we've discussed are for learning purposes only. Before making NY investment decisions, always consult with a licensed financial advisor who understands your specific situation, risk tolerance, and financial goals. Warren Buffett learned about compound interest the hard way at age 11. That $114 mistake shaped everything that came after. But there was another lesson he learned decades later, a lesson that cost him $23 billion. And it had nothing to do with selling too early. Next time, we'll explore Buffett's IBM disaster and the cognitive bias that traps even the world's greatest investor when he's in his 80s. Because if Warren Buffett can lose $23 billion to a psychological trap, what's sitting in YOUR portfolio right now?